Good afternoon and welcome back to the PSE, SBL, and short selling webinar series for market participants. I'm John Garcia, PSE's head for business development and market education, OIC, your host and moderator for this session. Today, we resume our webinar series with a discussion on SBL and short selling rules and regulations. Our speaker will give an overview of the rules and regulations governing SBL and short selling. He will also discuss the various SBL operating models and orient the audience on the salient points of PSE's short selling guidelines. So before we get started, here are a few reminders to our attendees. This webinar is recorded. Only the speakers and their presentations will be visible throughout this session. Ensure that your internet connectivity is stable and refrain from opening multiple browsers or downloading any programs to avoid disruptions during this session. Your microphones are disabled. However, this should not affect your ability to listen to the speakers. Please remember to check the volume control of your device. We enjoin everyone to actively participate during the live Q&A segment. Participants may type their questions in the Q&A box anytime during the webinar session. We have a set of panelists in the backstage ready to answer your questions in the Q&A box. After the presentation, we will take some of your questions live. Okay, let us now find out how many are watching us live. We have about 200 live attendees this afternoon and counting. So again, good afternoon, everyone. Okay, let me now introduce our resource speaker this afternoon. Attorney Roel A. Refran is the Executive Vice President and Chief Operating Officer of the PSE. He is a CPA lawyer who holds an MBA from Emory University's Goizueta Business School in the US, where he was a Fulbright scholar. Attorney Refran earned his Bachelor of Science in Business Administration and Accountancy, magna cum laude from the University of the Philippines, and his Juris Doctor degree, second honors from the Ateneo Law School. Attorney Refran is the recipient of the Distinguished Alumni Award from the University of the Philippines in 2014. Ladies and gentlemen, please help me welcome Attorney Roel Refran. Good afternoon, Attorney Refran.
Good afternoon, John, and I hope everyone is well, and we're looking forward to having hopefully a very informative session and interactive session for this afternoon.
Yes, sir. Well, for sure, our participants are very keen on listening to the PSE presentation. In fact, a lot of the questions we received yesterday are actually regulatory and compliance in nature. So, to our participants, please send those questions in. Okay, so with that, I'll turn over the floor to you, Attorney Refran. Floor is yours. Take it away.
Thank you, John. I'd like to ask that my presentation be flashed so that everyone can refer to the presentation. So we'll talk about the regulatory framework for this product of the exchange. And I just like to, at the onset, highlight now when you look at short selling and securities borrowing and lending, those are two different products simply because not all SBLs, as we call it, no, securities borrowing and lending, are with the end in view of supporting a short sale. But the reverse is, however, true, that a short sale will have to be supported by an SBL or a securities borrowing and lending framework. Otherwise, the short sale transaction will not be in accordance with the requirements of the exchange. And I'll go into a little bit detail on that later as we go along. So the title of my presentation is SBL and the regulatory framework, not just for SBL, but also short selling. The agenda for this afternoon is we'll be going through the regulations, the view from 60,000 feet, but we can do a deep dive on pertinent regulations as well. And then we transition to the operating models pursuant to the 2006 Memorandum Circular of the SEC, as adopted by the exchange into our program for SBL, as well as short selling. And then finally, we'll just do a review of the salient features of the exchange's short selling framework by way of the guidelines and the salient provisions thereof. Okay, so let's start. This is a brief timeline of the milestones leading up to the current framework of the exchange with respect to both SBL and short sales. Okay, if you look at this, it started in 2006. That was what, 17 years ago. where the rules of the exchange on securities borrowing and lending were duly approved by the SEC. And a year after, or roughly a year after, we issued our guidelines. And this is, when you say guidelines, this is really the implementing rules and regulation. And in the framework is consistent with the mother rules, which are contained in the PSE rules on SBL. And we also were able to revise in 2010 our trading rules. And what we did was we did incorporate the provisions of short sales, as well as the SBLs within our trading rules. And thereafter, 8 years after 2010, in 2018, the short selling guidelines were duly approved by the SEC. And this would again complete the regulatory framework of the exchange with respect to SBL, because in 2006 and in 2007, those were pertaining to SBL only, securities, borrowing and lending. And then in 2018, there is now the implementing guidelines pertaining specifically to short sales. Okay, and the guidelines again in 2018 were also duly published in our website for short sales. And thereafter, from 2018 to today's framework, the finer points were also resolved, specifically with respect to the collateral requirements. What are acceptable collateral? Is it just domestic collateral? Or can we also expand it to, let's say, offshore collateral? For example, there might be offshore collateral where it's listed and traded in other markets. And if that's acceptable, for example, to the lender, there was really just a question from the participants if that would be within the framework of the exchange. And finally, I think the most recent update here pertains to the modality whereby you are conducting your securities borrowing and lending not on a bilateral basis, but via an intermediary, which under the rules are called lending agents. So that's PDTC in this case, as of July of 2023, has been duly given the license by the Securities and Exchange Commission to perform the services as well as to comply with the requirements pertinent to lending agents, particular to SBL transactions. Okay, so what's not in this slide, however, is what actually triggered securities borrowing and lending by way of an introduction by the exchange. And this is really, if you look at the Section 199 of the National Internal Revenue Code, there's a provision there pertaining to exemptions from documentary stamp taxes. And in that section of the tax code, it's very clear there that for a securities borrowing and lending to be exempt from documentary stamp tax, it has to be duly registered and approved by the BIR, the Master Securities Lending Agreement. And this is why we in the exchange were able to come up with a product by way of implementing the provisions in the tax code. And it also ties up nicely with the implementing rules of the BIR via the revenue regulations, which we will also be looking at later on. Okay, so let's move on. The SBL and short selling governing rules and regulations. And it mentioned earlier, in 2006, the SEC, the Securities and Exchange Commission, came up with the mother regulations for purposes of SBL. And when you look at SBL, you might think that it's only for equities, but really it expands all the way up to debt as well. No, debt securities could also be the subject of an SBL, or equity securities for that matter, securities borrowing and lending. So it admits of other securities. Essentially, you might want to say it's really a collateralized loan agreement, except that it's not cash that you're actually borrowing, but it's actually securities that you are borrowing with collateral. All right, as discussed yesterday by our resource speakers, it's very clear that among the risks that they are most wary of, it's really counterparty risk, or the credit risk. No, the risk that there will not be a return of the securities as and when either you recall it or on the due date of the return. Right? That's why there is a very important feature, risk mitigating feature, as we would like to look at it, by way of the accepted collateral. So that's SEC Memo Circular 7, series of 06. And the same year, in 2006, after that SEC Memo Circular, there was actually Revenue Regulations 10-2006, also further amended 2 years later, Revenue Regulations 1-2008. Essentially, these are the implementing rules and regulations of the Bureau of Internal Revenue with respect to SBL transactions. Why is this needed? Simply because the underlying premise here is that whenever I lend securities to you, let's say, for example, shares of stock, it's not a straight up sale because our agreement is that you're only borrowing it, which means that there is that contractual obligation on the part of the borrower to return those shares to me. So it was very important that the SEC as well as the BIR and the PSE come up with a framework which will treat it as a loan and not a straight up sale, right? That's one. That is why as well the documentary stamp tax provisions of the tax code were also embedded in these revenue regulations. So the tax treatment of SBL transactions to eliminate at least or to mitigate assessment risk. Because if you are conducting, let's say, a short sale, and in order to make good on your settlement obligations 2 days later, right? We've already migrated to a T+2 settlement. So if I sell a security short today, that means that I am selling something that I have not yet in my portfolio. I don't get it. But I have an SBL, no, an arrangement whereby I can source it 2 days later. Then I am able to avail of the benefits of this revenue regulation. We'll go into some detail on the tax principles later on. And finally, in 2019, there's also the central bank, the Bangko Sentral ng Pilipinas, issuing the guidelines on SBL transactions pertinent to the equities market in PSE, borrowings by foreign entities of PSE-listed shares from local investors and lenders. All right? And I do understand also that the Insurance Commission is also fully supportive of the SBL principles simply because when we in the exchange look at who are the natural lenders, we always look at the long-term investors. No? That could be the pension funds, this could be the insurance companies, or the banks for that matter. Why? Because when you are able to come up with an SBL activity or transaction over otherwise idle securities, you're able to create extra income for and on behalf of the beneficial owners, right? So we are looking naturally at the long-term investors, including the insurance companies, the banks, as well as, for example, the qualified institutionals like the pension funds or the sovereign wealth funds, all right? So those are some of the regulations that are relevant if you're looking at the compliance aspect. Let's move on to the next slide. The PSE as well, as mentioned earlier, we have our framework contained not just in the revised trading rules, but also in our other issuances specific to SBL and short selling, as discussed a while ago. CMIC as well have also adopted their own reportorial requirements, and they've also enumerated what is expected of trading participants or the brokers. No? Brokers who may be engaged in securities borrowing and lending arrangements either on their house account, meaning they own the securities themselves and they're lending it, or it could be that they're engaged in SBL for and on behalf of their clients, no? In which case, these are client securities. And there are safeguards, not just in our rules, but also corresponding obligations imposed on the brokers, bearing in mind the investor protection requirements of the exchange. Moving on. Next slide, please. The borrowing period. No? When you look at any loan, the first question really is, what would be the price? No? How much? No? What's the interest? In the case of an SBL transaction, securities borrowing and lending, the rate would also be negotiated by the parties. No? The lending rate, or on the other side, how much will it take for the borrower to be able to use those securities? Remember, equity securities in the market are fungible, right? Therefore, if I lend to you, let's say, 1 million shares of a listed company, the expectation is that you are to return the equivalent 1 million shares as and when the borrowing period has already ended, right? So that's one. Second, for how long are you borrowing it? Under the regulations, the maximum period by which an SBL transaction can be pursued, complying with the rules, is actually 2 years. No? This is also embedded, the maximum 2-year period, embedded within the BIR revenue regulations, as well as the PSE and the SEC's regulations. All right. Other requirements will be contained in what was discussed yesterday as the Master Securities Lending Agreement. So think about it as a loan facility agreement. If you're borrowing money, or a loan agreement for that matter. So the equivalent agreement in an SBL transaction is what we call the MSLA, or the Master Securities Lending Agreement. What you would see there would be provisions not just on the rights and obligations of both the borrower and the lender. If there is a lending agent, then that would also be enumerated as among the parties to the transaction, right? But more importantly, what would be considered as default? When will a party be deemed to breach the terms of the agreement? And in which case, there would be a default. When there is a default, among the repercussions is that the transaction, while it originally was viewed as a loan agreement, it is what becomes now a transaction deemed sale, right? So now let's take a look at this bullet point, second bullet point, deemed sale. And I read as follows. Now, an SBL is deemed to be a sale when any of the foregoing or the following circumstances are present. Just to name a few, there's no stock return when it's expected to already be returned. It's returned, has to be returned because it's already the end of the borrowing period, or maybe there's a recall. Remember, as we learned yesterday, the recall risk is also among the risks that are very, very much important when you look at an SBL transaction, because anytime the lender may decide to recall, right? Even if we agreed, let's say, on a 1-year borrowing period, but one reason or the other, the lender says, I need it already. There's an important decision, and I want to vote those shares in my name, right? I don't want to just give a proxy to the borrower. Then the lender is at liberty to recall anytime, right? If there is failure on the part of the borrower to return equivalent, remember, fungible security. So the borrower could actually return the equivalent number or buy the equivalent number to satisfy the demand of the lender to return the securities. Failing which, that will result to a breach or a default. That's an event of default under the SBL MSLA agreement, right? So that's the first bullet point there. There's no stock return at the end of the borrowing period, right? And you go through this list on what are the transactions deemed sale. For example, if the shares were used other than for the specified purposes under the revenue regulations, in general, the main purposes would be to actually settle a settlement obligation. Otherwise, this would result to a breach on the part of the brokers to the clearinghouse. Our clearinghouse is what's called Securities Clearing Corporation of the Philippines, and it's very important that the trading participants on the second day from the transaction date, if you are the seller, right, that you are able to deliver the securities that you are selling, right? Otherwise, if you fail to do so, there are regulatory actions that will be imposed against the defaulting trading participant. Of course, the framework in our capital markets is that default should not be felt by the transacting parties, simply because the central counterparty, in this case, the Securities Clearing Corporation of the Philippines, will make whole, right? Will make good on the promise to deliver, except that the SECP will then run after the defaulting trading participant, right? In order to avoid that scenario, if, for example, by mistake, a trading participant places an order, right, or places a transaction to sell, let's say, 1,000 shares of a listed company's equities. However, it realizes that it only has, let's say, 100 shares, So it's short by what? By 900 shares. If that trading participant has in place an MSLA duly registered with the Bureau of Internal Revenue, compliant with the regulations of both the SEC and the PSE, then it could actually draw on that facility to be able to take advantage, right, of the supply coming from a potential lender. All right, that's one purpose. Fails management, as we call it, or risk management. A second purpose is by way of trading strategies implemented by, let's say, the trading participant. If that would probably be a short sale transaction, right? If you sell a security short, it means that you will have to comply with the regulation of the exchange, proper flagging, but more importantly, you'll be able to deliver on the second date from transaction date the securities that you sold. And how can you deliver it? You normally would tap on the facility, which is the Securities Borrowing and Lending Facility, provided that you do have an MSLA contract in place. Okay? Now, failure to comply with the essential features of the MSLA clearly would constitute default, or failure to register or delay the registration of the MSLA. In short, all of these transactions deemed sale would have to be clearly spelled out, no, because they are in one way or the other events of default under the MSLA, or the Master Securities and Lending Agreement. In the same way, if you look at a loan facility agreement, right, if you borrow money, there would also be events of default or breach, right? The acts of default, events of default would also have to be clearly stipulated, simply because there are rights that may be resorted to by the lender in the same way that there are rights that will also be resorted to by the lender participant in an SBL, to ensure that it is able to avail of, let's say, the options, for example, that it may have over the collateral, right? Because the borrower posts a collateral, then there might be an avenue for the lender to also foreclose on the collateral. Okay? Now, taxes. The shares are not subject to stock transaction tax or the capital gains tax in the EST. The underlying premise here is because when you do the SBL leg, it's really a borrow. It's not a sale, right? That is why it has to be consummated. It has to be compliant with the framework of the exchange. Otherwise, you run the risk of a tax assessment, all right? For example, you do an SBL and it is not pursuant to an MSLA that's duly registered and approved by the BIR, right? Now you have a tax assessment before you because the Bureau of Internal Revenue says, why did you not pay the stock transaction tax, right? DST on secondary has already been removed. But back in the day, DST was still there. Remember, this is a 2006, 2008 revenue regulation. No? Now we know for secondary transactions, no DST anymore. But there might be an STT, right? So if that assessment comes around and you happen to engage in SBL within the framework of the exchange, then you could readily address that assessment. However, if there is no such compliance with our rules and you pursued your securities borrowing and lending, let's say, to make good on a short transaction obligation, then you will not be able to invoke the provisions of the revenue regulations in your favor, right? So that's the most important point I'd like to highlight, the assessment risk, right? As well as the compliance risk with respect to both the exchange and the SEC for conducting an SBL. All right? All right, let's move on. The concept of manufactured dividends or benefits, this was also touched upon yesterday by some of our speakers. Essentially, when I lend securities to you, right, the lender's perspective is that if there are corporate actions, if, for example, there are accruing dividends throughout the period of the borrowing, right? Let's say it's a 1 week borrowing period, 1 month. If there are, however, corporate actions, and I, as the lender, am supposed to be entitled to certain rights, such as dividends, or maybe, if there are stock rights, for example. The premise here is that because there's actually a transfer of title, right? You, as the borrower, are supposed to make me whole as the lender. And how do you do that? If you're the borrower, you manufacture the dividends or you manufacture the benefits, whatever you receive, right? By way of you, as the borrower, now having legal title to the shares that were lent to you, right? And you will be using that for whatever purpose, as I mentioned. Could be to support a short sale, or could be to prevent a potential fail with the clearinghouse, right? You have to manufacture the dividends by agreement, right? Pursuant to your MSLA. And this is also very clear in the regulations of not just the PSE, the SEC, but also of the BIR. All right, you're supposed to return or reimburse to the lender whatever dividends or benefits in accordance with the terms of the MSLA. All right, because it's not really a straight up sale. It's really just a loan. You're supposed to make me whole with respect to those corporate actions. Okay, so that's the economic benefits of a shareholder. What about the political rights, the voting rights? You look at the second bullet point in this slide. The voting rights should still be with the borrower, right? Because the borrower now has legal title, right, over the shares of stock. Okay. However, consistent with the general principle that the lender should not feel that he or she lost the shares. It's as if the shares never left the hands of the lender. Therefore, when you look at the political rights, technically, the borrower still has to ask for a proxy on the part of the, essentially in the MSLA, right? There has to be mutual agreement, effectively giving the borrower voting rights. No, although legally you would say the borrower already has legal title, but because it's just a loan, right? It's not a straight up sale. Then the voting rights provisions of the MSLA actually also stands to protect the interests of the lender, right? Because these are really just loan shares. There has to be clear stipulation on this. If there's no clear stipulation, who has the right? Therefore, if there's no stipulation who has the voting rights, it will be the legal owner, and that's the borrower. All right? That's why it's important when you negotiate the MSLA that not just the economic rights, but also the political rights will have to be clearly agreed upon between and among the parties. Next, collateral. When you look at collateral, this we tied this up with the discussion yesterday on risk. If you are the lender, foremost in your mind is the default risk, right? Or the credit risk, as they call it, in a loan. In the same vein, if you look at an SBL, that is also the primary risk assumed by the lender. No? What if when I expect the shares to be returned, it does not come, right? The answer is, well, there are other rights and other remedies that you will have to avail of as the lender in case of default, right? And one of them would be you may want to foreclose on the collateral. And this collateral can be in the form of cash, could be in the form of government securities or equity securities that are listed, could also be an LC, a letter of credit, right? A standby letter of credit issued by a bank, or such other forms of collateral as allowed by the SEC pursuant to the framework of the exchange. As mentioned earlier, right, offshore collateral now is also allowed, but specifically for qualified institutional buyers only, okay? Because there are concerns that were raised by the Securities and Exchange Commission with respect not just to the enforcement mechanisms. Remember, if you say offshore collateral, they are within the control of, let's say, the foreign exchange, no, not in the PSE. Therefore, to mitigate what may otherwise be a misunderstanding on the part of the retail as to how there could be recourse against the collateral, the SEC only approved the use of offshore collateral pertinent to QIBs or qualified buyers. Okay? The value of the collateral, the regulations provide that if your collateral is not cash, for example, now there could be securities, right? There could be equity securities or non-equity securities. Then the general rule is that this will have to be agreed upon by the parties. No, what haircut or what would be the allowed collateral value. For example, if you have given by way of collateral, let's say government securities, GS in general are the default risk by the government when they borrow from the public is pretty much, I would say, close to zero because the government does not default. Therefore, the collateral value there, the minimum is really just 102% of the current market value. All right. If, however, what's given to you by way of collateral, and it's a borrower that will provide this to you, are listed equity securities, you know very well that on a given day, the trading band for an equity security listed in the exchange could be up by 50% or down by 30% any given day, right? And the mark-to-market requirements, right, for the collateral and the mark-to-market activities will be done, right, either by the lending agent or the lender, okay? They would then have to ensure that the risk from the day's trade in terms of the price dropping, right, there's no problem if it's the price going up, that if the price goes down, that they're able to ask for a top up in terms of the collateral. So that's why if you look at the minimum, it's actually still small, 105% for equity securities, right? As opposed to, let's say, GS or government securities, really just 102%. So the parties can stipulate whether they want a 140% collateral requirement or 150% to cover the potential fluctuation in the price if what's given is a listed equity security. But they're also at liberty to agree on, let's say, another threshold subject to the limitations provided for purposes of the collateral. Okay, so take note of these minimum requirements by way of collateral. Next slide, please. Now, I mentioned earlier, when you look at the underlying contract between the lender and the borrower, including the lending agent, if there be a lending agent, you will have to look at the MSLA, right? Because it outlines the relationship and the responsibilities of the lender and the borrower. Yesterday, our speakers mentioned that it could also be what's called the Global Master Securities Lending Agreement, or GMSLA, as we call it, no? And GMSLA, there is a particular template for GMSLA. However, on a case-to-case basis per jurisdiction, there would necessarily be pertinent customizations or amendments, no, or annexes, simply because you cannot standardize all the legal requirements and regulatory requirements across jurisdictions. While you have an MSLA, it always has to be bespoke. It has to always be customized to the particular compliance requirements and regulations where the SBL transaction is taking place. Okay? Now, the MSLA, or if you're using, let's say, an addendum to an already existing MSLA, right? The purpose of the loan has to be stipulated, right? It has to be very clear that it's among the allowable purpose. For example, it's for to support a trading strategy, right? For risk management, and then these are allowable purposes. It has to be specified in the MSLA. The collateral, in terms of what types of collateral, will be required by the lender, right? The particular valuation, as we discussed a while ago, right? And also, if what's given by way of collateral is cash, right? And the borrowing period, let's say, is more than, let's say, it's 2-3 months, is there an obligation, or is there an expectation on the part of the lender, right, who has control and access to the collateral, which is cash? Is there an expectation that they should also invest that? Because in the event that collateral is returned, there might be accruing interest, right, or investment income that should also be given back to the borrower. So it's very important that the parties agree, right? If the collateral can be and should be reinvested, and what are the allowable reinvestment outlets for purposes of managing that collateral. All right. So, and other provisions pertaining to collateral would also have to be stipulated in the MSLA. I mentioned that the fees are among the most important terms in any SBL, and the lending fee is contractually agreed upon between the lender and the borrower, right? If it's a security that is scarce, in that it's not in ready supply, then maybe the lender can ask for a higher lending fee. No? I've seen lending fees probably in the area of 400 basis points to 600 basis points. Otherwise, if it's not a scarce security, if it's easily obtainable, then it might be a more, I would say, obtainable. No? If it's more realistic, a lower lending fee that may be agreed upon between and among the parties. Okay, so that's the fees also required to be in the MSLA. Next slide, please. Okay, the requirement also is for there to be a clarity, no, clear characterization of whether the lender is lending the securities which it owns in its own behalf, meaning these are what we call prop or house securities, proprietary, because it is acting for and on behalf of its own house, right? If the borrower, for example, would have to know that, or if the lender is actually lending securities which it does not own, but it is lending because it has been authorized by its clients to lend the securities. Okay. In the example I gave a while ago, let's say you are a insurance company, right, and you have accounts with our brokers because you are trading, although you are a ultra long-term investor, right, because you're looking at long-term potential claims based on the policies that you have issued, right? Let's say life or property insurance. In the meantime, what you want is for there to be extra income. So what you're doing is that you could give instructions to your brokers that if there are potential borrowers, you are giving authority for your broker to actually lend your securities. Anyway, you have no use for them. in the short, even in the medium term. Okay, so that has to be explained and has to be characterized in the MSLA, whether you are a principal or you are acting as an agent for and on behalf of your clients. Now, when you look at the word agent, there is a little twist there later on because of the concept of a lending agent. Okay, but here, this will clarify whether the securities are owned by the lender itself or it is really just authorized by the ultimate beneficial owners to lend those securities. Okay. Another term that has to be very clear in the MSLA pertains to distributions and corporate actions. I mentioned that earlier. There might be dividends that may be declared during the borrowing period. The principle here is that those such benefits or dividends will have to be reimbursed or returned by the borrower to the lender. Why? Because it's not a straight up sale. It's just really a borrowing facility. The representations and warranties, as is usual, will have to be stipulated between and among the parties, and also the term or the duration of the contract. Okay. Now, when you look at the duration, I'd like to highlight that the ability of the lender, okay, to recall and to demand a return of the lent securities cannot be taken away in general, right? And as in fact, yesterday it was also highlighted that the lender does not even have to give a reason why it is already pre-terminating or recalling the securities, no? Because it has absolute control over the securities, even if it just lent it to you for the short term. Okay. All right. Let's move on. Next slide, please. Now, that's the MSLA. There's a lot more terms that you are at liberty to agree with your counterparty, but those are the essential points, right? It also has to be agreed upon by the way that the parties are supposed to register the MSLA with the BIR in order to avail of the tax incentives. And I earlier mentioned what would constitute events of default because there are tax repercussions and there are also obligations that will be required of the parties. Now, depending on who is the injured party or depending on who is the party who is in breach or the guilty party. Okay? Next would be, because I mentioned earlier that your securities borrowing and lending will have to be within the exchange's framework, there are reports that will be required of the transacting parties to the SBL. And we'll just run through some of the reportorial requirements for your benefit. No? You'll have a copy of this presentation. So just want to highlight, for example, the confirmation notice is on a per transaction basis. No? The first row of report here, we call it the securities lending confirmation notice. Okay, on a per transaction basis, it will have to be covered by a confirmation notice, but this will be contained in the biannual reports. Okay, you will then submit that not just to the SEC, but as well to the CMIC, right? The watchdog over the brokers, and you also have to furnish if you are the lender, the borrower will have to, the brokers of the borrower will also have to give notice to their borrowers as well as the lender side that they have confirmation that there's already an SBL. In the same vein, if there is an intermediary, the lending agent will also have to have a records, right, in case they are audited by the regulators. Okay, if it's just really the parties bilateral SBL, then it's really just the lender and the borrower. And the memo circular, by the way, just like to highlight also that there later on we do have different models for doing an SBL, but anytime it's really just contractual bilateral, then normally that's what we call the direct lending. Okay, but anytime you are engaging the assistance or the services of a lending agent, then that's a lending agency model. We do have a couple more slides later on to just really highlight these provisions, no, for better benefit by those in this session. Next, second row. Go back to the previous. No? Next report is what we call the SBL transactions report. Okay, again, also on a per transaction report. And we do have templates for this, no, for purposes of complying with these requirements. In the same way, you look at 3 biannual reports in this slide. You have the summary report of the securities lending. You have to submit within 15 days. pursuant to the CMIC rules, and 1 month of the covered period pursuant to the BR rules. No, outstanding SBL transactions is very important because there are safeguards that we have embedded, for example, in the short sale regulation of the exchange, that we are actually putting a maximum, we call that the short interest ratio, SIR. So we want to make sure that SBL transactions which have already been closed will be duly reflected in our records as well, no? To make sure that we are all aligned on what's outstanding or what has already been closed, because the securities that were borrowed were already what? Returned, right? They're not anymore termed to be outstanding. There's also a biannual report for that. And finally, again, liquidated SBL, so that we also know that the obligations of the parties in the MSLA have already been duly fulfilled. Therefore, there's no outstanding loan anymore. Okay? Next slide, please. Certification, submission, other reports here pertaining to both the lending ledger on the part of the lender, right, containing all the records, also on the part of the borrower. These would all be facilitated, no, normally by your trading participant, the brokers. Okay, and finally, the short position report to be submitted to the CMIC also is in consonance with the short interest ratio maximum, right, that we do have under our rules, and that I will have a slide on that later on for your reference. Okay, next slide, please. The operating models, no, in general, just like to go through some of them. Next, please. Model number 1, essentially, this is a direct lending. No, if the parties are allowed to engage in direct lending, no, and if you look at Section 7 of the 2006 Memorandum Circular, for example, if you're a bank, your investment house, insurance company, pension fund, you are authorized to engage in direct lending, right? You don't have to go through any more an intermediary, for example, right? In which case, if the trading participant lends as a lender, right, to its clients, all right, then the borrower are its clients. And maybe it just so happened that the trading participant has positions, no, in his house account or in his prop account. Therefore, it is at liberty to be what's called a proprietary lender, meaning the shares that will be lent by the trading participant are shares that it owns, no, in its own name, not just legally, but also beneficially, as opposed to there being a beneficial owner behind the trading participant, in which case that's its client, right? In which case, in this case, model 1, it will be the broker and the client who will be the parties to the MSLA. And of course, that will have to be compliant with the regulations of both the SEC and the PSE and the BIR. And for the parties to submit that, not just to the PSE, SEC, but also duly registered with the Bureau of Internal Revenue. This is the first model. It's a broker as a proprietary lender, and its counterparty would be its clients. It's also very convenient for clients because if the clients, for example, want to engage in a short transaction, it picks up the phone or maybe issues an instruction to the broker. The broker will say, but you don't have a position in this particular security you want me to sell for you, right? However, if we have already an MSLA in place, then that position, even if it's not yet there, on settlement date, right, there could be a settlement because of borrowed securities by the client coming from the prop account of the trading participant. Okay, so this is model 1. Let's look at model 2. Now, here, the trading participant is acting not on its own behalf, right? But it's actually acting as an intermediary or a lending agent, okay? The lending agent under the 2006 Memorandum Circular of the SEC is a go-between, right? In short, it facilitates the SBL transaction because it has a view of what shares are available for lending, number 1. It also has information on potential borrowers, right? So it's pretty much like it's matchmaking, right? It's matching a potential borrower with a potential lender, okay? If a broker wants to be a lending agent, then the requirement here is that they will have to be duly licensed by the Securities and Exchange Commission to perform lending agency services. No, the fact that it's a broker does not mean automatically that it can provide lending agency without the imprimatur or the approval by the Securities and Exchange Commission. Right? That's very fundamental. Let us assume that a trading participant has been duly licensed to be a lending agent. Right? So here you're looking at the following agreements. Now, first, you have the MSLA between the lending agent and the borrower, and there has to be an authorization from the client lender, and that will be contained in what's called the Securities Lending Authorization Agreement. All right, Securities Lending Agreement, which authorizes, right, the broker to also lend the shares of a client as a lending agent. Okay. Question: can the CAIF of the brokers with their clients contain a specific clause which says that, you know, for purposes of administering the client's shares or securities, the client gives consent, right, in general, to the broker as it may deem fit? Is that sufficient for purpose of complying with the SLAA? The answer is the general, all-encompassing provisions in the CAIF would generally be not compliant with the requirements for express SLAA authorization. In short, this is like a special power of attorney or an SPA in the form of an authorization agreement. It cannot be a general power of attorney. It has to be identifying what are the securities that it's allowing the broker to lend and under what terms and conditions, right? Otherwise, the requirement of a documentary support on the part of the lending side, no, and this is the broker, which will have to be authorized by its client, no, to lend the client securities, that will be lacking. Okay, that's also an assessment risk or an audit risk on the part of the brokers. All right, so this is model number 2, where a duly licensed lending agent is a trading participant. Now you have to have the MSLA between the lending agent and the borrower, and on the part of the lending agent, it has to be supported by an SLAA. Otherwise, that transaction will be reflected, no, as a sale on the part of the client's account, no, and the client not having authorized the lending will definitely have a cause of action against the unauthorized lending. That's why it's very important that the broker be able to get the consent on a specific basis of the client via what's called a securities lending authorization agreement. Okay, so this is model 2. Let's move on to model number 3. Now, if you look at model 3, here there are different trading participants, okay, and they are performing intermediation. All right, different clients of the TPs, right, can borrow shares through the TPs, which then could execute an MSLA with a third-party lending agent. If you look at model 2 a while ago, it was actually the broker who was the lending agent. Here, right, it could be, let's say, PDTC, right, duly approved as a lending agent, who will then engage with interested TPs, right, for purposes of potential SBL transactions. Okay, in these cases, the TPs acting for and on behalf of their clients are what we call under our regulations as the agent facilitators. Right? If you look at our rules in the exchange, these are what's called agent facilitators, and that's pretty intuitive because they're really just agents. It's not house accounts. That's their client securities, and they're acting as facilitators. Now, they're not acting as a lending agent, but as agent facilitators. No, because anytime you represent that you're a lending agent and you are not duly licensed by the SEC, then there are regulatory actions that may be enforced against you, right? So that's why it's important you know your role as a broker. Here, if there is, let's say there's a platform provider offering lending agency services, no, and you subscribe to that platform, make sure that you have you are compliant with the requirements, no, as you could see in this slide, SLAAs, MSLA, and the service agreement. Okay, between the client and the TP, there has to be due authorization because the TP will act not as a lending agent, but as an agent facilitator, right? And the TP will then submit that information to the lending agent, right? Therefore, there also has to be clear SLAs emanating from the client. And then the lending agent and the borrower will have to be governed by the terms of an MSLA. And as regards the borrower and the client, the client of the TP, who actually is the beneficial owner of those securities, legal owner being the TP, there will have to be a service agreement between them, because there might be fees. And normally, there will be fees that will be charged by the trading participant borrower in the event of an SBL. All right. So what are the agreements in Model 3? SLAA, MSLA, and the service agreement, or the SA. Okay. Now, let's take a look at another model, right? Model number 4, the last model. If you look at model number 4, we contradistinguish this with a domestic participant SBL. Here, foreign clients are the ones who are borrowing the securities. Maybe it's in order to address a potential fails with the clearinghouse. Foreign clients can borrow shares by executing an MSLA, again, with an intermediary or a lending agent. Now, if the foreign clients have, let's say, a bilateral agreement, MSLA, with potential borrowers, then that's good, no? Except that the problem is, as and when you engage in trade transaction exchange, you may not know in advance whether you need the security or not for potential fails management. No? In which case, engaging the services of a lending agent is very advisable in order to have that ready access to potential securities in order to make good on your settlement delivery obligations on T+2. Okay? Now, this model requires the services as well of a custodian bank for the delivery of borrowed shares from the lending agent to a local trading participant, no? Because it's the local trading participant which will execute the selling transaction of borrowed shares in the open market. Okay, so here we also included, although tomorrow there is a more in-depth discussion on the PDTC side, particularly what we call the EQ facility, the EQ trade. Essentially here, you have the cast of characters, no? The lender, and then the borrower is a foreign, let's say, foreign investor, right? And then there's also the lending agent between them. However, for delivery purposes, you will be engaging the services. The foreign borrower will have the services of a custodian bank, all right? And then also the lender, right? The local lender, local broker would also be executing, right? The particular sale transaction. Okay, the executing broker selling, and all of these will be covered by SLAAs, MSLAs, custodianship or custody agreement, right? As well as the steps on the back office to make sure that you're able to transfer the shares. Remember, these are shares that are really just the subject of loan agreements. Normally, you will also reflect that in the PDTC to make sure that the transfer of the securities are also reflected in the records of the depository. So the Central Securities Depository, through the EQ trade, we call it the EQ trade, will be able to match their records with the actual transaction for the SBL. Okay? So this is something for you to be mindful of when you look at potential borrowers who are foreign clients. Okay? And this is really just a summary of the agreements that we saw in the previous slide, just for your ready reference. Okay? Next slide, please. Now, that's SBL. Just to recap, when you look at short selling, it is not synonymous with SBL, number one. No? But when you look at SBL, it is a tool by which you could comply with the short selling guidelines and regulations of the exchange. Okay? But we've also learned that another general purpose of an SBL is for fails management. Okay, for fails management, simply because there might be fat finger errors, there might be unintended errors, inadvertence, I would call them, on the part of the execution side of a brokerage house, whereby they need a ready facility to make good on delivery obligations, no, if you're the seller. And so you would have to engage with another counterparty broker for short selling, or maybe if there's a lending agent that actually makes it easier for the parties to participate, no, in the short facility or SBL. Okay, now short selling guidelines of the exchange. Let's just go through them in general. All right, but the at the onset, when you look at a short sale, it is actually a transaction pursuant to the Securities Regulation Code, okay, whereby you are selling a security which you do not yet own. However, you have a facility or a contractual arrangement to source the securities that you are selling today. No, maybe you have a bearish sentiment on a particular security. You expect the price to go down, and you have that firm conviction. Therefore, you may be best suited to already execute the sale today, and then just borrow in order to take advantage, let's say, of the potential gain, no? Because your expectation the price will go down. If the price goes up, you still have to make good on your settlement obligations, no? Even if your potential revenue actually became evaporated into thin air because price went up instead of going down, right? As short sellers expect prices to go down. Okay, now the core principles of that being a short sale transaction. What are the core principles? No, first is, under our rules, naked short selling is not allowed. No, this is an offshoot of the 2008-2009 financial crisis, where there were jurisdictions at that time where there was no prohibition against naked short selling. As in fact, there was also some jurisdictions in 2008 where they did not have what's called the uptick rule. Okay, the uptick rule, we also ingrained that within our regulations. You are to short sell only at one tick size higher than the last traded price. No, if your market does not have the uptick rule, therefore you could actually bring down the price really on a downward spiral, right? And our market has that legal requirement of an uptick. But on the regulatory side, we don't just have the uptick rule, we also have what's called the prohibition against naked short selling. No, what's naked short sell? You are short selling without an MSLA. You are short selling without a supply facility for the delivery, right? Because you tag it as a short, which means you are acknowledging you don't have that in your portfolio, in your position with the PDTC. Therefore, the next question is, how can you deliver on settlement date, right? On T+2, where will the securities come from? The answer should be from your MSLA, because you could borrow from a potential lender, right? If the answer is, I don't know where to get it, maybe I'll knock on the doors of other brokers. That's not allowed, right? That's not allowed, because that's what you call naked short. What we do allow is what's called the covered short. No, you have to cover the short by an SBL. That's the first principle. Second, we have later what's called eligible securities. No, not all securities are eligible for short selling, right? And this is as our regulations stand. There have been observations, no? And I've read some of them on why they feel it would be best to open up the gates for short selling to all securities. Maybe we're not yet there. We want to make sure first that only eligible securities, those which are the most liquid, right? Because they are in our indices, they are eligible for short selling. Okay, that's the second core principle. Third core principle is that because we have what's called the short interest ratio, and this we adopted from other jurisdictions, no? At any given time, eligible securities should not have more than 10% of their outstanding shares via outstanding shorts. No, the upper limit is 10%. It cannot be more than 10%, right? That is why there are requirements for us to monitor properly and effectively the outstanding short position for the eligible securities, right? That's a third important leg of our framework. Now, there's that reportorial requirement. And finally, it's also important in our trading system, the front-end system, that the proper flagging of an order as a short sale, right, is fully complied with, right? Because you have to already identify, right, from the get-go that particular sale transaction is a short. And there's a mandatory requirement. Plus, it also allows us to monitor, right? And you will also have to flag properly whenever there are buyback orders. Okay, so this allows us to close the loop with respect to a short sale transaction, whether it's still outstanding or whether it's already been duly returned by the borrower to the lender. Okay? Now, let's move on to the other salient features of our short selling guidelines. As mentioned earlier, are all securities eligible for short selling? Right? Can you short all securities, no? Just because you have a firm conviction that the price will go down in the short term. You have a bearish sentiment of that particular security. Answer, no, because the eligible securities are only the following, no? The component stocks of the index, our 30 company index, the PSEI, all right? The mid cap and the dividend yield index member companies, no? The 20 member companies of the mid cap and the dividend yields will also be eligible for short selling, right? As well as exchange traded funds, no? ETFs, no? They're also eligible for short selling. Okay, second important principle when you look at the short selling guidelines of the exchange, no? Is the short interest ratio, as I discussed a while ago. An eligible security must maintain a short interest of at maximum, no, 10% of the outstanding shares. No? It could be lower, but it should not be more than 10%. Okay? Third bullet point here, that trading participants shall determine that the client has entered into the necessary borrowing arrangements because of our prohibition against naked short selling. Okay? And that has to be within the knowledge of the trading participant, because if you go back to the slides we discussed a while ago, those agreements will have to be maintained and will have to be also within the custody of the trading participant, right? So it's not a defense that the trading participant will say, I did not know that my client did not have that borrowing arrangement, that I inadvertently was engaged in naked short. Okay, that's not generally going to be allowed, because there are responsibilities and there are obligations imposed on the trading participants when they do the short for and on behalf of their clients, including the mandate for them to determine that there's already the necessary borrowing arrangement, even before they enter the short sale transaction. Okay? It has to be very, very clear. Right? Flagging is important, as discussed earlier, and we do have end-of-day reports on the transactions, both the short selling transactions as well as outstanding short positions for the eligible securities. Okay? And the last point here in this slide really pertains to the uptick rule. In general, under the Securities Regulation Code, you are only allowed to do a short, provided that your short sale is one tick size higher than the last traded price. Okay? In general. Now, there are exceptions to that when you can probably be at least at the level of the last traded price. No? And this will also be part and parcel of the enforcement and the audit risk issues that trading participants will have to also be mindful of, no? The compliance with the uptick rule pursuant to the Securities Regulation Code. All right, next slide, please. Other salient features, depository participants, the PDTC participants should indicate whether the transfer of shares to another broker or depository participant is for the purpose of short selling. There's also a flagging mechanism in the EQ trade facilities whereby they could actually also monitor, right, the movements on the SBL transaction from the broker or the depository participant who is lending all the way to the broker or depository participant who is borrowing. Okay, that has to be also duly flagged. Okay. Furthermore, transfers of shares within the depository participants' omnibus account for short selling and buyback of those transactions will have to be duly classified and duly reported to the exchange. Okay, we need that information, and that's a responsibility of the broker because we're also monitoring the short interest ratio. And finally, the SBL borrowing and returns will also be duly facilitated via a template. We call that the Daily Depository Participant Report, or the DDPR. So not to worry about the information, the formatting, because we have facilitated already via what's called the DDPR, right? Your reports that will be required of you whenever you are engaged in SBL borrowing and lending pursuant to a short sale. Okay? Now, I just like to highlight some final notes, no? When you are looking for the exact regulation, I suggest you go to the website of the exchange. So if you're on the homepage, you would take a look at the menu buttons, and there is that trading icon there, or trading option. So if you click on the trading option, what will appear on screen would be the following, right? You have investing in PSE or products and services, and then trading participants and other potential information that you may have use for. But if you're looking for SBL, go to the products and services menu, right? Because second to the bottom, you would see there SBL and short selling. And when you click through that, you would then be able to access the wealth of information, the regulations, as well as the FAQs that we have, right? That hopefully will guide you as and when you engage in SBL. Why would you want that? Because as I mentioned earlier, and this is front and center for the trading participants, no? In general, they want to comply with all applicable regulations, no? Why? Because of the tax consequences, number one, assessment risk, and secondly, because there's also regulatory risk on the part of, let's say, the CMIC, where compliance with the framework of the exchange for SBL would have to be substantiated by the brokers, no? When they do short selling, or when in general they do SBL, right? So we have here the FAQs, both for SBL and short selling, and the downloadable information as well for purposes of the SBL. Okay, so I hope this is a ready resource that I suggest everyone take advantage of for your familiarization and your better understanding of the principles. Okay, some key takeaways that I feel just bear emphasis. Okay, the first one is that short selling and SBL in general, no, SBL can be a risk management tool, right? Because in general, short selling, you might say, I'm engaging short selling because I see a potential profit, no? I see that the market price does not reflect the efficient price, for example. So my view, based on my computation, that the price that you see in the market is gonna fall tomorrow or the next days. Therefore, there's an arbitrage opportunity, right? Then I do the short sell. So in that sense, yes, it's an opportunity for you to profit, no? But again, the short sell can only be coupled with an SBL, right? The short sell can only be coupled with an SBL. That's why when I say here, it's a tool for managing investment risk, it's because the counterparty of the short seller is and that's a borrower, right, is expecting the delivery of the shares that you sold, no? Except that because it's a short, you're not yet the owner at the time of the execution on transaction date. Therefore, we want to make sure, right, that market participants, why they want to take advantage of arbitrage opportunities based on maybe mispricings, no, and their belief on the law of one price, that the securities really gravitate towards its efficient price. We want to also make sure that the delivery obligations, no, on the seller's side would be duly fulfilled. Okay. While they speculate, we will not allow naked shorts, no, and it's a tool to manage risk as well for purposes of certainty of the transaction, certainty of well, I mentioned earlier, the central counterparty will be the one to make good on the failed delivery. There's also that corresponding recourse by the central counterparty, the SCCP, against the defaulting broker. All right, so that's the first point. Second point is that we have the regulations in place other than for an efficient SBL and transparent transaction, also to address the tax assessment risks, right? I think that's one of the biggest risks other than the the credit risk or the default risk. You don't want to be engaged in SBL and run afoul the tax regulations, right? That's why if you look at the 2006 and 2008 regulations of the Bureau of Internal Revenue, right? Essentially, what they're saying is that throughout the time that this is an SBL conducted within the framework of PSE, you can enjoy some sort of an exemption. It's not treated as a sale, but really just a borrow. Okay? Now, remember, if it's a borrow, if it's a loan agreement under the tax code, there might be DSTs, no? But here, because it's conducted through the facilities of the exchange and the borrow happening through our facilities, it's very clear in 06 and 08 BIR revenue regulations that this is provisionally tax-free, right? Because there is no capital gains, there is no stock transaction tax, and DST, right? Both on the borrowing and provided that there is a compliant return, no? Because if the return does not happen, then it's what you call a transaction deemed sale. From the get-go, it will now be treated by the BIR as a sale transaction without the benefit of the 2006-2008 regulations on SBL, right? So for you to enjoy the tax benefits, the most important first step is that you have an MSLA that's duly registered with the BIR, number one, and it will only be duly registered and approved by the BIR pursuant to the framework of the SEC and the PSC if you are compliant with the minimum requirements, and that has to be duly reflected in your agreement. Okay, that's the second key takeaway I'd like to emphasize. No, finally, the role of lending agents. So some people always ask, transparency and market information is very important to decision making, right? And that's centrally the theme of the efficient market hypothesis. No, and you always say that to aid us in decision making, show me all relevant information, material information. Okay, now when it comes to borrowing and lending, your handicap as a borrower is you don't know who has the supply of those securities, right? Or for that matter, whether there are potential lenders who are willing to lend to you at a reasonable commercial rate, right? And so you are stumped because you don't know who to approach. You don't know unless you already have an MSLA in place bilaterally with other trading participants. No, but let's take the scenario that you do not have that. No, so that is the exact predicament that a lending agent seeks to address, right? Because a lending agent will provide information, right, on what are the available for lending securities, okay, for purposes of borrowers who are searching for those securities, right? I include here a statement that they are playing an important role in facilitating the securities borrowing or for short selling, including, let's say, collateral management, no, inventory mark to market of the collateral, also standardizing the terms, no, standardizing the terms of the MSLA, as well as probably rationalizing lending rates. There will be clarity on what are the available lending rates. So if you are the potential borrower and you agree with that, then the lending agent can connect you with the potential lender. And that's the role of the lending agent. Of course, in tomorrow's session with the PDTC, PDTC has just been approved to be a duly licensed lending agent. It would also be good to also understand from the lending agent's perspective, what are the risks that they are also taking on? Are they a central counterparty? No, this early we know that they are not a central counterparty, but what services are they going to provide to the borrower and to the lender TPs? No, and to that end, that would probably be most relevant in tomorrow's session. Okay, so these three key takeaways, I hope, will be relevant to you as you further understand the SBL transactions and the requirements. No, I think there seems to be a slew of regulations, but just understand at the very heart of an SBL transaction, it's really just a collateralized loan, except that other than cash, what is being loaned is actually securities. No, and those securities, because they may be owned by the lender themselves, no, the house, then that's well and good. No, but in the event that those securities are owned by the beneficial owner, the clients, no, although in our framework they are all immobilized in the omnibus account with the PDTC, the requirement of under the regulations that you get the authorization from your ultimate client. Okay, that also closes out the discussion on the investor protection features of SBL. So I hope that's been useful for everyone, and I'm more than happy to address any questions that you may have on the regulatory framework for SBL, both from the PSC side or even on the tax authority side, the BIR.
Thank you very much, Attorney Refran, for that very informative presentation. As expected, we already have a lot of questions in our Q&A box. Some of them were answered by our panelists already. We still have around over 20 questions. We'll try to take as much as we can. We have 275 live attendees this afternoon. Okay, so I'll just go through the questions and then just throw it over to you, sir. First question I have here: can publicly listed companies opt out of having their stocks lent out. So in the presentation, sir, there are eligible securities for short selling, but can the listed companies express their desire not to be included in the eligible securities? What are our rules on this, sir? Sir, you're on mute, sir.
Thank you, John. We go by the property rights of the owner, right? The real owners here are the beneficial owners, no? Or if it's owned by, let's say, a trading participant, they have property rights over securities, no? So if they want to lend them, as I mentioned, for example, if you're GSIS or SSS, no? Or for that matter, let's say your insurance company, and you want to have extra spread simply because you're ultra long-term investor, right? And if you're ultra long-term, probably you'll be devoting your portfolio to maybe more than majority of fixed income and some for equities. Let's say 30% equities. So the extra spread that you get owning those securities, let's say they are PSEI securities, you're also looking for that. No, it's a yields play in today's market. So if can the company say no, you cannot earn that from a legal perspective? That's not a decision for the company. It's a decision of the owner of those shares, no? Because securities that they have bought and that they have in their portfolio, they're at liberty to lend them out or sell or buy more of them, right? So I think in yesterday's session, there was something struck me, no? There's a lot of benefits also with respect to looking at a short sale transaction, right? There's price discovery, there's risk mitigation, and also gives an avenue for the market to incorporate views. And it's opposing views that make for a market. No, not everyone will always have the same. You might say if someone is short selling because they have a bearish view on the security, they know that it's going to go down. Of course, it's not certain, but they feel it's going to go down. Why is someone buying, right? Because they're opposing views. That buyer may have a, bullish view on the market. That buyer might say, "Oh, I think this is going to go up, so this is a good deal. I'm buying," right? So we in the exchange, as a platform provider, as a regulator, we want to give due course to this exchange of ideas. And that gives way to what we call the price discovery mechanism, right? If there's negative information about a particular company, then expect that there might be a slew of short sellers. No? They feel that would result in downward pressure, that might exert rather downward pressure on the shares. Then there might be a short sale, right? There might be a rush to short sell the same security. We cannot say, no, you cannot do that because the company said you cannot short sale that particular. To me, it's a property right. It's a decision of the investors.
Very well said, sir. On the SBL borrowing period, in the slide earlier, it showed there that the maximum is 2 years. Is this the usual tenor for an SBL in other markets? And I'd like to add to the question, can the SBL have a shorter tenor also?
Definitely.
Not
You could
necessarily
have
2 years.
you could have maybe just 1 week. You could have 2 weeks. Normally, the term of the loan, no, is dictated by, let's say, the commercial decisions also. No? So the longer the term, the higher the rate, right? Let's say if I quote you a 4% per annum lending rate, and the time that my quote unquote loan was outstanding was really just for 1 month as opposed to a full year, then you don't get to pay equivalent of 4%, right? Because it will have to be a portion throughout the time that your quote unquote SBL or the loan was outstanding. So, but there are cases where they feel that they would have a need for securities on longer term basis for whatever reason, then that's really the call of the parties. But the simple answer is yes. 2 years is really just the maximum. You could stipulate a shorter period, maybe a few days, maybe a couple of weeks. And there's really they're at liberty to stipulate, no? The parties have full autonomy to decide the borrowing period for as long as it does not exceed 2 years. Because if it's more than 2 years, that will not be duly approved for registration purposes. No, we will not endorse that for approval by the BAR because that's not going to be compliant with the requirements.
All right. We have here actually 2 questions from one attendee. I'll start with the first one. We've been receiving these questions since our webinar sessions for the back office operations personnel, and also during the first webinar session yesterday, do we already have a target on the implementation? When could we expect the implementation of short selling at the PSE?
Right. So, as mentioned a while ago, in 2018, we did get the regulation for short selling already approved, right? And even prior to that, because we provided that you cannot do a naked short, the existing regulation SBL, which we also fine-tuned, by the way, further fine-tuned on the collateral side just this year, July of 2023, we were also able to dot the I's and cross the T's, so to speak. No, we're able to close outstanding issues, except for one more for the tax outstanding question on whether I could register a GIMSLA, which is the Global Master Securities Lending Agreement. I feel that we're at the tail end, and by the fourth quarter, hopefully by November or earlier, John, no, we're already able to formally say that together with the PDTC as the lending agent, that these are all we now have the storybook complete, right? For purposes of trading participants who want to make sure that they're not out of bounds when they do the SBL or the short, for that matter. No, it's been a long time coming, but when you look at the technical requirements, the reportorial requirements, the end of day, and also not just from the front to the middle to the back office, it's probably gonna come full circle in the next 1 or 2 months. Now, hopefully in this, we'll see. We're moving everything to make sure that we already launch this, because when you're looking at volatile markets, as mentioned earlier, it could be an opportunity for arbitrageurs, no? And there could also be occasion for potential investors to also take advantage of this product.
Well, hopefully, Attorney Ruel, 2023 is the year. Next question from the same attendee. Can retail clients also participate in SBL and short selling? I think our attendee is from COL, especially for their online clients.
Right. So very good question, because if you look at other markets, no, let's say you look at South Korea, you look at Thailand, you look at the profile of their the investors who actually engage in SBL, you see that a lot of them are retail investors. No? Although, if the brokers may want to educate the investors on the nuances of a short, because as we have seen in the meme stocks craze, when was that? More than 2 years ago. Instead of the stocks prices going down, it actually went up by what's called a short squeeze. So in the end, the instead of the transaction resulting in a profit, it actually resulted in mark-to-market losses, right? Because you sold at 5 pesos and the price went up to 10, for example, so you have to borrow at 10, then you have a problem, right? You're in negative territory, as opposed to you selling at 5, and then you're supposed to return the share. You borrow a share worth, let's say, 3 or less than that, because your bearish sentiment on the price materialized. Maybe you do have very good predictive skills, right? Then that's a gain. So what I'm saying is, when you look at the revenue potential, normally it's not just a question of I feel this price is gonna go down, so let's do a short. No, I think it's incumbent upon the intermediaries to also inform their clients that there is also that risk that the price will go up. So if you do a short, you have to run the risk you're actually selling it at a lower price compared to the price at which you're going to acquire it, because a short means you don't have those shares yet. No? So I think that's a long story, but what we normally expect would be the institutionals, because they do have their risk management in place already. They're taking this risk, yes, and they may have counter positions. Maybe they have other derivatives, for example. In the event that the price, instead of going down, goes up, then they have other options that they can avail of, for purpose of ensuring or mitigating that risk, as opposed to, let's say, just reading the gut feel of an individual retail investor. But is there a legal disability on their end? There's none, right? They can participate in SBL even if you're a retail investor. But probably our invocation to the intermediaries and the trading participants is for the clients to look at this not as, a game of chance, no, because trading is not a game of chance, but as a deliberate trading strategy on the basis of information that has been properly processed, no. So hopefully, as and when retail investors engage in SBL, they are very much aware that there's a risk that actually the arbitrage may actually evaporate, as I call it, and become a loss.
Right. They have to be fully informed of the risk that comes with participating in this particular product. But perhaps, sir, on the lending side, especially if the retail investors are long on their position, then they can also be part of this program and enjoy also the benefits of having part of the collecting the lending fees. Sir, earlier you mentioned that not all TPs can act as a lending agent. They will have to secure the necessary license and imprimatur of the SEC.
Right.
How about for the agent facilitator? Is there a license required for it? What are the requirements to be an agent facilitator? Say our participants or our attendees this afternoon are interested in participating through the model number 3 with PDTC right in the middle as a lending agent.
Right. So that's very good you highlighted that, John. No? For you to be a lending agent under the auspice of the framework of the SEC and the PSE, there are, for example, specific technical requirements. You have to have risk management, internal control procedures, automated securities lending system, and other risk management requirements before they give you the license. No, but for agent facilitators, what's required only, number one, there's no licensing required on the part of the SEC or the PSE for agent facilitators. That's a term that we use under our rules to clearly demarcate the lines that whenever a TP is not acting as a lending agent simply because it's not licensed to do so, but it is executing the instructions, for example, of the beneficial owner, let's say, an institution or a retail investor, that they want to gain an extra income, right? As and when they do that, they have to be mindful that they are doing it not as a lending agent, but as an agent facilitator, which means that the requirements on confirmation, for example, making sure that the clients are duly informed of the terms would also have to be explained to the client. In short, they still have a role to play in the sense that they will have to properly advise their clients that, okay, if you want to lend this, there's a risk in exchange for the lending fee that is to be potentially generated. No, there's a risk that, for example, when it's time for you to return, we may not have ready supply for this. No, and so if that's the case, how could we mitigate? Then the client may say, why don't you borrow again? So yes, that's one modality by which you could mitigate that potential fail or breach, no, or default. No, and that's the obligation of the broker as an agent facilitator. So it's aligned with the general principles that brokers are guiding the clients in terms of the nuances, especially because SBL, as I said, to simplify, it's really just a loan agreement. So if you're the creditor or you're the lender and that's your client, no, they are lending those shares, you also have to understand that realistically there are risks that cannot be modeled into the equation. There might be risks because suddenly a war breaks out and all that. You don't know how the markets will be. The market risk may be so such that you may also have second thoughts on lending it, right? Because you also feel, if you are a long only investor, those shares are there because in 10, 20, 30 years, you expect to monetize those shares. No? So you have to weigh those interests between and among all the considerations, John. And essentially, the agent facilitator is front and center of that. No? Iba yung lending agent. If you're a lending agent, you're actually very active in sourcing because you have information, you have a view on who are the potential lenders and who are the potential borrowers of that. And that's also leading. It's like you're operating a let's say a one-to-all or an all-to-all system. Remember, in trading systems, we have what's called one-to-one, one-to-all. Whenever you come up with the lending agency model, you're opening it up so that it's not just one-to-one, but all-to-all or one-to-all. Now, there's multiple participants, and that's occasioned by the fact that you have information, market data available. These are the securities that may be lent. And so it's not as difficult as you knocking at the doors when you only have 2 days, let's say, for a failed settlement, no? And those doors may not readily open. So if you have a lending agency in the middle, you have somehow, some sort of comfort and peace of mind. When you need it, it's there.
Speaking of roles in the various SBL models that you discussed earlier, as hopefully the SBL program and the short selling program of the PSE becomes successful, and as this matures, our trading participants would probably be acting more than just one role. Is it possible? Can a broker act as an agent facilitator and also a TP borrower, say in a separate transaction simultaneously? Are there any constraints that you foresee when it comes to this, sir?
I think each SBL in and of itself, each SBL transaction in and of itself um, can be treated independently of, you may be TP prop lender on the one hand, and then on another transaction, you may just be an agent facilitator for your clients, right? If the TP opts to be licensed as a lending agent, right? I think that's they see the business case for that. Maybe they see that we could provide a service in exchange for a good commercial basis that they could charge. Then that's also something that they could if you're a lending agent, then the transactions will have to be in accordance with the system, duly approved, the technical requirements, especially on the collateral management. Normally, the collateral management is a tricky part, right? You have the daily mark to market, and of course, the variation margins, as we call it, for purpose of collateral management. I will require, let's say, if our agreement is 150%, and because of market forces, mark to market today, the value goes down to below 150, then you top up, right? So that's a responsibility of the lending agent. Otherwise, that's a default, or the lender for that matter. So I would say yes to your question. They could be wearing multiple hats per transaction on a per transaction basis. But if you decide to be a lending agent, that has to be very clear that when you perform certain services, it's you being a lending agent and not you being a agent facilitator, because the roles are definitely of a higher scale and a more significant requirement for a lending agent compared to an agent facilitator. So an agent facilitator really just facilitates for and on behalf of the client, making sure that they are acting on behalf of another person and that they're duly authorized. No, as I said, it's like an SPA, special power of attorney, except that we have what we call the SLAA, the lending authorization agreement.
All right, sir. I'm trying to combine the questions, at least those that are related, so that we can maximize, Attorney Roel's time with us this afternoon. PSE has a prescribed template for the MSLA. It's available for download in the PSE website, as you shared earlier. We have questions from various attendees. Are we also going to release a standard template for the SLAA? How about for the service agreement between the borrowing broker and the borrowing client? Is there a standard that we will be releasing, or they should follow, that our market participants should follow?
I think, as far as I know, the central agreement released the MSLA. Yes, we do have that guidance. The SLA essentially is in the nature of an SPA authorizing you. As I said, what probably will not save the day for brokers acting as agent facilitators, really just that catch-all provision in the CAIF, right? That any and all, it could be to the effect that the client ratifies or duly approves any and all acts of the broker to implement, let's say, the foregoing and all, because the SLAA has to categorically specify that there is that consent on the part of the client owner, that they are allowing brokers to, let's say, lend securities, ABC securities, or such other securities. So if there's a need for a template, maybe just some guidance documents, we'll be more than happy to guide you on that. But it's not as complicated as an MSLA. So we feel that while the terms can be for the parties to stipulate. It's really just the authorization or the consent of the client that's the most important. No, it doesn't have to be a two-pager. It could actually just be a one-page document. No, in the same vein, the service agreement, on the other hand, is really for the parties to agree on. The only reason why we have the MSLA is because we looked at the global template of the ISLA, right? In the same way you have for repo agreements, we have the GIMRA. Here we have the MSLA for purposes of aligning so that we speak the same language across jurisdictions. But when you look at bilateral arrangements such as a service agreement, I think the parties, there are no specific regulations that they should be wary of. No, in short, it's for them to bargain against each other and to agree on. So it's really just the MSLA that probably would we feel would be most useful to the participants. So feel free to agree on the service agreement that covers the obligations that you expect of each other, commercial and otherwise. But really, when you look at the MSLA, we have a template because we will endorse that to the BIR for registration. No? That's not the case. We don't endorse for registration your service agreement. And just to also highlight, we don't endorse for any registration requirements or SLAA. No, it's really there to document the relationship and the authorizations. But it's the MSLA that we will have to pass upon, and we'll have to hopefully endorse to the Bureau of Internal Revenue.
Okay, we have here a couple of questions regarding the MSLA registration timeline and the fees. So how long does it usually take for participants to have their MSLAs reviewed, pre-cleared, and registered all the way to the BIR? And who pays the fees and how much?
That's a tough question. Okay. To be very, very honest, what happens is that we will endorse the PSE, and then once it passes our scrutiny, we go. The SEC will also have to pass it upon the MSLA before it gets endorsed to the BIR. No, actually, the process should be straightforward, because what happens is that the framework and the regulations are that of the PSEs and the SECs, right? But I could not give you, let's say, I hope I could say 1 month or a couple of weeks, because we have had occasion where there have been bilateral MSLAs that have been pending for maybe years already, with the tax authorities. No, and I think that's one of the gaps that we're trying to address now, to streamline the processing, because the final go-ahead will be with the BIR. Why? Because the tax regulation, the tax code requires a definitive approval. No, it has to be duly registered and approved by the Bureau of Internal Revenue, the tax authorities. No, as to the fees, I know that there is now on the SEC part, I think they are now going through public comments with respect to the fees. In so far as the SEC and the BIR are concerned, I remember it's not significant. No, it's not very significant. I think it was around just, John, parang 5,000 pesos. No? I may be, and then on the, so fees are not very much the key consideration here, but the time. So what's our suggestion? No? Because of the timing element, no, and let's say you already need the securities, I don't think in 2 days you could register, right? That the value therefore of a lending agency model is very, very much, I would say, very high, simply because the lending agent can actually invoke the 2008 regulations, no, for what's called the multilateral MSLA, such that there will be one-time registration, and there will then be reports to ensure that as and when there are actual SBL, the participants via the lending agent on a multilateral basis, no, that would also be captured in the data of the Bureau of Internal Revenue. But as long as you have duly registered the master MSLA in a lending agency or a multilateral basis, that's already compliant with the registration requirement. I know there's I just like to repeat, if it's bilateral, you go to the BIR one every time you have an MSLA, right? As I mentioned, the challenge there might be time consuming, and the approval timeline might be uncertain. No, one way or the other, we don't like that, right? We don't like that, because you want to have an MSLA already in place, because tomorrow you don't know if there might be a potential risk, a failed settlement that you don't want to breach the rules of SCCP of, no? And so that's the value of a lending agent. And I think in tomorrow's session, maybe PDTC could also further highlight what other value propositions they have for the participants. So fees around 5,000. Timing, wow, I wish I could say just 1 month, a couple of weeks, but rest assured that on our end, we are working to streamline, no? And we feel that the rules are pretty straightforward. It's not very much, I wouldn't say it's ministerial registration, but I also wouldn't say that it entails a lot of, back and forth in terms of the particular provision, because the rules conform. Whenever we endorse, it means it already passes scrutiny of the PSC and the SEC.
All right, thank you, sir. So the fees, it's 5,000 per regulator. So 5,000 for the PSE, 5,000 for the SEC, 5,000 for the BIR. Is it right, Sir Ruel, if our participant registers a multilateral MSLA and it's already registered all the way to the BIR, is it also possible that the additional borrowers will just be added in the addendum and will not have to go through the review of the PSE and the BIR if it's the same MSLA anyway?
Yes, but may fee component pa rin yun. There's still a fee.
Yes, sir, with the
component
BIR, sir.
With the BIR. But yes, you're right. Because it's merely like they are acceding or agreeing to the MSLA.
Yes, sir.
Therefore, there is no new MSLA. Just imagine the agreement to be the borrower and seller, right? A borrower rather and lender, or the borrower lender, and then there will be accessions as and when people want to participate in the lending agents program, right? So therefore, the rights and obligations will be uniform, standardized, and that's the value of it. And therefore, that's already been duly registered and passed upon by the regulators. But because there might be, the repercussions, then as and when there are accession, I think this goes with the principle that fees should not be the consideration, right? It's probably insignificant in the large scheme of things. You don't want to be in breach of the SCCP rules, and whether for an error, that inadvertence, or probably to settle on a short sale that you executed for and on behalf of your client.
All right, sir. Well, we've covered quite a lot on SBL and the SBL operating models. For the last question this afternoon, I'd like to touch on a particular short selling scenario that our market participants are thinking, and would like to get your thoughts on this, Sir Ruel. It's part of operating an exchange that securities get suspended. And in the case of a suspended security, buying back the shares to be returned, to the lender might be a challenge for the borrower. And what if the period of the SBL has already lapsed?
Right.
What can be the option? So this is really more of a negative scenario.
Right.
What could be the option of our market participants in this
Very
case?
good question. So when they did the borrow, it was not yet suspended, and that
it's not yet suspended. It's still eligible. Actually, there's also the eligibility as well, right? So
right.
The securities can be eligible today and not eligible tomorrow if, for example, in the daily report it reaches the 10% SIR.
Right.
So
the eligibility requirement is for purposes of executing the short sale, right?
The short sale. Yeah. So that's not really the issue. Yeah.
Yes, when you're able to have a match for the short and it's eligible, then it will be well and good, right? Subsequently, you're correct. No, it might be a long-term borrowing, but at least on the short component, there's no regulatory risk of non-compliance. Now, the problem is, as you mentioned, what if when it's time for me to return, you could not return because you could not source, or you could not return because you could not force it through the exchange. If the question pertains to the second scenario, you could not return because you could not force it through the exchange, and your MSLA does not provide for an alternative. It has to be, you want to protect your interest as the borrower. Let's say there's a recall, John, of suspended securities, maybe there's an AGM, ASM coming up. They want to vote it themselves. They don't trust you, and the borrower, they want to vote it themselves. So they recall, return it to me, and then you're gonna say, how can I return to you? I could not get it from the market because it's suspended. So now, if that be the case, since you could not return it, there will be a resort to collateral. They could foreclose on your collateral, right? They could also, if it's cash, then it's easy to determine what's the value, right? Maybe the last traded price before it was suspended because you don't have a current market price. But if it's, let's say, other securities given by way of collateral, whether that be government securities or let's say other listed equities, then the lender would have ready recourse, or the lending agent would have ready recourse to that collateral. There are set procedures already in place. So your problem now is that you will have to make whole the lender or the lending agent, because but that once it's fully, if they're able to foreclose your collateral, it will already be considered as compliance. Baka lang there might be other penalties because you're now in breach, right? And what to me is probably bears emphasis on that question is, if there is a breach, so there's a breach, then there might be tax repercussions already because it might be considered a deemed sale, right? The reason why there's collateral management foreclosure is because there's a breach. You don't foreclose if there is no breach. Therefore, the event of default comes before foreclosure. So in that case, to me, if I'm the tax authorities, that's clearly a breach. Therefore, it's a transaction deemed sale. In so far as the lender is concerned, they could take care of their interest by foreclosing the, if it's a security interest now, right, under prevailing laws, there may be arrangements whereby the personal property that's given, like shares of stock, they have recourse for that as well, assuming they have priority. There's other legal requirements for that, how to make sure that you have what we call the perfected interest. You have first priority against the whole world, right? So I think that question is beautiful in my mind because it forces us to think of the risks. But the answer was straightforward because there are provisions in the MSLA that will protect the lender from default risk or counterparty risk, as we call it, or credit risk, because as you mentioned, it could not be returned. However, there are tax and other regulatory implications that will definitely be triggered because of that default scenario.
Right. On that note, our market participants, especially the borrowers, will just have to be mindful of all the risks involved in the transactions, and definitely that scenario is one of them. So thank you, Sir Ruel, for answering our questions. To our participants, thank you for sending in your questions. As much as we want to answer all of them, we are limited by the time we have. But the good thing about Zoom is we can extract these questions and supply our answers offline and probably send them across to all the attendees for everyone's benefit. I do have two questions here that I would like to take on real quick, Sir Roel. There's a question: will the fees be standardized if PDT through the PDTC model? Please stay tuned. Attend tomorrow and ask Ms. Tess Ravalo about this. Definitely, they'll be more than happy to answer that. And another question is: do the brokers need an additional back office system for this? Very practical question. What we call that is actually Securities Finance and Collateral Management System. PSE will be hosting a series of introductory meetings next week. We will be sending invites to trading participants that have registered in our webinar series this week. Please do join us. No commitments, just to really learn more about how the other markets and other market participants are doing it. All for our learning experience. Attorney Roel, before I let you go, parang kanta ng freestyle, sir. Ano lang, key takeaways. I know nagbigay ka na ng tatlo kanina, but if you want to give more key takeaways to our market participants, sir, the floor is yours.
Oh, I think in general, when you look at a loan transaction, right? What is central is you only engage in a loan transaction because you need it. So it's to be used sparingly. Why? Because of the risks, right? Other than the economic repercussions, you have to pay a lending fee. You also have to also pay service fees to the lending agent because it does provide value, as I mentioned earlier. But more importantly, it's really the awareness of your clients, because ultimately you are on the execution side as the broker. Therefore, it's of no moment that the broker will say it's the instructions of the client, because ultimately you will have to execute the transaction, whether it's a short or you will have to be a party to the SBL. It's not your client, no, because the client may not be qualified to be a direct lender. You, however, as a broker, can be a direct lender or can go through what's called the lending agency model. So I think that's a blind spot for brokers. You will have to explain that to your clients, no, that these are the risks and that these are the expectations, just to manage also the expectation of the clients. But through it all, I think it cannot be disputed that, and it was very telling yesterday, no, in terms of the outstanding SBL transactions on a global basis, I can't remember if it's 2.8 or 4.8 trillion US dollars that our panelists mentioned yesterday. No, whatever it is, it's really widely used by participants, no? Whether that be retail in markets like Thailand, I mentioned, or in South Korea, where there's a very advanced derivatives market. The SBL does also complement their derivative strategies, not just really the underlying stock, no? Also the derivatives strategies. And that may be a reason why they have a very thriving SBL market, because it's not just the cash market, but also the derivatives market. So we're getting there. We in the exchange are working to also develop derivatives products. But I think the fundamental legs on which our strategy to develop the market, for that strategy to stand on, one of the legs is really a robust SBL framework. And we are more than happy to address any questions you have, because this will be the base of future products that we will be offering in the exchange.
And on that note, we would like to again thank PSE COO Attorney Ruel Refran. Let's give him a virtual round of applause. Thank you very much, Sir Ruel.